How do you diversify your investments when you have little money to invest? Are ETFs a good alternative when you can't meet the minimum requirements to invest in a mutual fund? And what's a really easy way to get some extra cash if you're in a pinch? We'll answer these questions and more on this, the 45th episode of the DoughRoller Podcast.
Welcome to the DoughRoller Podcast, where the best thing money can buy is financial freedom. We help you make more, spend less, and invest the rest. And now your host, Rob Berger.
Whether you're just starting out, buried under a mountain of debt, or well on your way to financial freedom, this is a podcast to help you take your finances to the next level. Hey everybody, welcome to episode 45 of the DoughRoller Podcast. Today we're going to cover, I think, a great question that I received from a listener named Daniel, and it has to do with how you invest and have an asset allocation plan when you're just starting out and you don't have a whole lot of money. You know, in the 31-Day Money Challenge, we talked at length about the importance of an asset allocation plan. But with sometimes the minimum amounts required just to open up a single mutual fund, if you're just starting out, how in the world can you invest in 3, 4, 5 mutual funds for your asset allocation plan? You may not have enough money. Well, we're going to cover that question today. And the good news is there are plenty of ways to get around that problem, and we're going to cover those today. Before we get to Daniel's question, let's talk first about the tool of the day. And this one everyone's heard of, and it's Excel. You think, okay, well, great, Excel. Yeah, we can do a lot with Excel, but why is that the tool of the day? And so what I want to do today is give you just a real quick trick that you can use Excel for. Some of you may know this, but many of you may not. And there's actually a lot of useful applications with Excel and personal finance. But what we're going to cover today is really quick. How do you calculate the payment on a loan in Excel? Let's say you're thinking about buying a car. Now, you know, for those that have listened, you know, my strong recommendation is don't borrow. But you know, there were times when my wife and I had a car loan, and you know, when you're thinking about this kind of issue, it's real easy to figure out the payment in Excel. Now, there are calculators on the internet, of course, and you can track those down and use those. Frankly, I prefer to use Excel just because it's so easy, and you can quickly change the assumptions and interest rate and the amount of the loan and recalculate the number. And so here's how you do it. In Excel, you'll see at the top, right above all the grids, is a bar, and it has an FX to the left of it for function. And by the way, if you don't have Excel, you can do the same thing for free in Google Docs. Just open up a spreadsheet in Google Docs or Google Drive, I guess they call it now, and the functions are the same. And in that function box, all you do is type the equal sign, and then the function we're going to use is to calculate the payment. So it's PMT. So it's equal PMT, and then an open parentheses. And the first thing, we're going to put 3 numbers in this parentheses. The first is the interest rate. And since we're going to calculate the monthly payment, right, we want the monthly interest rate. So the easy way to do that is to take whatever interest rate you can get. In the example I used for this podcast, it was 5%. So the first number that I'll type in this parentheses is 0.05 divided by 12. That gives me 5% is the annual interest rate divided by 12. Gives me the monthly interest rate. You put a comma, and then the number of months. So if it's a 5-year loan, it's going to be 60 months. So you put in 60 and a comma, and the amount of the loan. I put in $20,000, but whatever it is, close the parentheses and hit enter. And in the cell, you will have the monthly payment. In this case, about $377. Simple as that. And then you can change it, obviously, very easily. As I do this now, if I change it to $10,000. It immediately changes the payment down to $188. And of course, you can change the interest rate, the term. I can say, well, what if I want to pay a $10,000 loan over a 30-month period instead of 60? You know, type it in, you get the different answer. In this case, it took the payment up to $355. But you know, Excel, there are a lot of functions like that. And once you know them, they're very easy to use, and it can be very helpful in a lot of things, including how long it'll take you to be a millionaire, how much you're investing, what your return is. It's very easy to calculate. Maybe I'll cover some of those other formulas in future shows. But to calculate the payment of a loan, just equal sign PMT, and then open parentheses, you're going to have your interest rate divided by 12, and then a comma, You're going to have the number of periods, number of months. Say for a 5-year loan, it'd be 60 months, comma, and the amount of the loan, close the parentheses, hit enter, and there's your payment. Simple as that. Okay, on to the question for today, and I'll read a portion of Daniel's email. He writes, he says, first, thanks so much for all the work you've done with the podcast. I recently discovered it through your interview on the YoPro podcast, and I quickly binged through all of your back episodes. Well, most of them, all of the ones that applied to me right now. You've provided one of the easiest to understand explanations of how interest rates affect bonds in one of the podcasts. I'd heard other people discuss it and read articles about it, but it didn't click until you explained it. Thanks. And all of the other information you've provided is great as well. An amazing, valuable resource for folks like me, young and trying to figure out finances. Now that, of course, wasn't part of Daniel's question, but I don't know, I like getting emails like that. Since it's my show, what the heck, I'll read that first paragraph. Appreciate that, Daniel. And by the way, if you haven't checked out the YoPro podcast, you can find that in iTunes. I was on that show. They interviewed me, and it's a great podcast, so you ought to check that out. Anyway, Daniel goes on, he says, I have a quick question I was hoping you could address on a podcast or maybe answer in an email. Before I give details on my situation, I'll go ahead and ask the question up front. If I don't have enough money to purchase the minimum required by Vanguard or Fidelity or Schwab for their mutual funds and establish asset allocation at the same time, is it okay to slowly purchase equivalent ETFs until I have the minimum investment required by the mutual funds? Now, Daniel goes on in his email. I won't read it all, but he goes on to explain his specific situation. And here's the thing he's struggling with. And we'll use Vanguard as an example. For their basic mutual fund, there's a $3,000 minimum to purchase, any of their funds. And you can imagine having an asset allocation plan where you have 3 or 4 or 5 funds you want to buy. Maybe you have a U.S. stock fund, a bond fund, maybe a foreign fund. And, you could even want some real estate, a REIT fund, and maybe emerging markets exposure. Maybe you have an emerging markets fund. Well, that's 5 funds right there. You need $15,000 to invest into all of those funds, $3,000 minimum for each times 5. And when you're just starting out, you don't have that kind of money. And so it's a very common hurdle to try to clear, again, when you're first starting out. And so Daniel's question was, well, I don't think they have minimums for ETFs, exchange-traded funds. So, maybe I should try that first until I can meet the minimums, and then maybe take the investments that I've got and eventually move them over to the mutual fund. And so I emailed Daniel and I gave him my thoughts, but I thought this was an important topic. And so I want to cover 4 ways you can deal with this issue, particularly for those that are just starting out. Before I get to those, I should say at first that this is not a problem for 401ks. When you have a 401k at work, they don't have minimums like they do if you're going to invest directly with a mutual fund like Vanguard, Fidelity, or Schwab. In your 401k, you should be able to invest in any of the funds that they have with your monthly contributions and slice and dice your contributions into whatever funds you want. So this really isn't and shouldn't be a 401k issue. That's the good news. However, if you're opening up an IRA, a Roth IRA, a taxable account on your own, and that's a great thing to do, then you could have this problem. And so how do we get around it? What do we do? Well, here are four ways. I'm going to start the first one with what I did. So when I first started investing, it was in 401k. I didn't have this issue, but immediately I wanted to invest outside the 401k. And like Daniel, I didn't have the money to go out and buy, the minimums required for 3 or 4 or 5 funds. So my approach was just to start with one fund. Yes, it's not my perfect asset allocation, but I was starting out with, I think, $100 a month. And at that time, I could invest in what was called the Legg Mason Value Trust. Now, if you've been investing for a long time, you know Legg Mason Value Trust. It was run by Bill Miller. He was one of the top fund managers. It was an actively managed fund that beat the S&P 500 for about 15 years. I actually left that fund while it was still in its heyday, still beating the S&P. I pulled out of that fund while it was still doing great. And the reason I did was because I knew it wouldn't last forever. And I knew that when it started to underperform the market, and I believed that it eventually would, I wouldn't have the courage, if you will, to stay in that fund. And that's when I made the switch to primarily index funds. But in any event, I was in that fund for a while. By the way, it did eventually crater. That may be too strong a word, but it certainly underperformed the S&P 500 significantly, as most, if not all, actively managed funds eventually will. But in any event, I just started $100 a month. Was it the perfect asset allocation plan? No. Did I have emerging markets and a foreign fund and a bond fund? I didn't. I had the Legg Mason Value Trust Fund. That's what I had, which was basically a U.S. equity fund. But I was also investing really small amounts of money. I mean, I was just getting started. $100 a month is, I think, where I started. And so my view was that's okay. I don't have to have a perfect asset allocation plan day one. I'll start with just one fund. And then when I have enough money to maybe buy into a bond fund or a foreign fund, I'll do that. And I'll kind of add mutual funds and diversification as my assets grow. It won't take that much. And yeah, I may have a couple of $1,000s in a single fund, but still it's fairly well diversified. I mean, the fund owned a lot of different stocks. And with the money I had invested, I thought that was okay. And if you were going to look at a Vanguard fund and you needed $3,000 to invest in it, I think it's a perfectly fine option to save your money in a high yield savings account. And then when you have $3,000, buy into your first fund. I think it's a perfectly fine strategy. So that's the first option. The second option gets to Daniel's question about ETFs. Now, I've covered ETFs and how they're different than mutual funds. You can check that out in the 39th episode of this podcast. So just go to DoughRoller.net/podcast 39, and you'll find that podcast, Mutual Funds versus ETFs. But to Daniel's question, ETFs are an option. The reason they're an option is that because most ETFs, unlike a mutual fund, don't have minimum investment requirements. For example, with Vanguard, the minimum you have to purchase is just a single share, and a single share of an ETF is usually, it can vary, but certainly under $100. So you could, even with, say, $1,000, invest into a number of ETFs that are virtually identical to the mutual funds, right? Again, if you listen to podcast 39, you'll see that, like with Vanguard, for example, they have ETF versions of mutual funds. They're almost identical. That is an option. Now, a couple of things, though, to be aware of. First of all, in most cases, you have to pay a brokerage fee when you buy an ETF, just like you do when you buy an individual stock. And so as you're investing small amounts of money, those brokerage fees could make this option a non-starter. It could just make it too expensive. That's one problem. The second problem is the bid-ask spread on ETFs. There's a difference between what you pay and what the seller receives, and that spread goes to the market maker, the person, the company handling the transaction. And so that's another cost that you have to pay when you buy an ETF. Now, that bid-ask spread varies depending on how liquid the ETF is, how popular it is, if you will, how many people are buying it. But sometimes those spreads can be significant. So that's another downside to this approach. The third potential downside is that ETFs generally don't automatically reinvest your dividends for you. That goes into a cash account associated with your brokerage account that you then have to reinvest on your own. And of course, if you're reinvesting them in ETFs, guess what? You're right back to paying brokerage fees and the bid-ask spread. So there are some hurdles with the ETF approach. Now, having said all of that, there are some solutions. Vanguard is one of them. Vanguard, when you open up a brokerage account, minimum of $3,000, they don't charge brokerage fees if you buy Vanguard ETFs. Now, there still could be a bid-ask spread, but they don't charge brokerage fees, right? The second advantage to a Vanguard ETF is that the expense ratio of their ETFs is lower than the investor class share of their mutual funds, which is what you buy if you invest $3,000. Once your account gets to $10,000 for a fund, you can qualify for what they call Admiral class shares, and the expense ratios come down to typically what the ETFs are. So that's something to consider with Vanguard. They do solve some of these hurdles that you might have buying ETFs somewhere else. And by the way, Fidelity or Schwab or some of these other well-known companies, they may have offer the same sort of setup as Vanguard does with no brokerage fees and that sort of thing. I just am not as familiar with them. So you could check that out as a possibility. The other thing Vanguard does is they do reinvest the dividends for you automatically if you want. So that's nice. So in the case of Vanguard, ETFs, I think, are more of a reasonable alternative when you're dealing with, when you're just starting out and and you don't have a whole lot to invest. So ETFs are an option, but again, I think only if you find one like at Vanguard, where there are no brokerage fees, they reinvest your dividends for you, and that sort of thing. So that's the second option. The third option when you're just starting out is something like Betterment. If you listen to the 31-Day Money Challenge, you know that Betterment was one of my sponsors for that. I invest at Betterment. And what Betterment does is it takes your investments and then spreads them out over a number of ETFs, including Vanguard ETFs, as I think a couple others. And they do this for you. And so you don't have the minimums issue because Betterment's investing for a whole bunch of people, and so they have presumably millions of dollars in these various ETFs for all of their clients. So the minimums aren't an issue. And so you can open up an account at Betterment and get started with very little money, and you don't have to worry about the minimums of each of these mutual funds. You don't have to worry about that, and so it's a great way to get started. And I've been happy with my account at Betterment, and I kind of did it sort of as an experiment because when Betterment started, I'd already been investing for, I guess 20 years or so. So I had in my taxable account, I wasn't going to move anything because, well, for one thing, just the taxes would be, the tax I'd get hit with, so I wouldn't move everything to Betterment. But I opened up an account, and I have an automatic deposit every month that goes in to one of the accounts there, and I've been very happy with it. Very easy to use. And so Betterment's an option. Okay, the fourth and final option is a fund of funds. And I've talked about this in the 31-Day Money Challenge. Again, if you go back to the podcast on investing, and I would start around podcast 25 and 26, those two in particular. But mutual fund companies will offer a single fund that you can invest in, and they will take your money and spread it out over a number of their funds to give you instant diversification. And Vanguard offers these. I know Fidelity offers these. And so there you just have to deal with the minimum for that one fund. Again, it's for Vanguard, it's $3,000. But once you do that, then you have your money invested in a number of funds at Vanguard for you. It's very easy to do. And the great thing is that Vanguard deals with the rebalancing all of your money for you. And so there with just a $3,000 minimum, you could get great exposure to the foreign fund, U.S. equities fund, a U.S. bond fund. Again, all with one mutual fund. So very simple to do, and that would be an option for you as well. Vanguard calls these their all-in-one funds. They have some that are specifically designed for retirement, where you invest in the fund that's geared towards the year that you're going to retire, and as time goes by, they will change your asset allocation to make it a little more conservative as you get closer and closer to retirement. They also have what's called a life strategy fund, and you can pick among 4 different asset allocations, ranging from 20% stocks and 80% bonds, all the way up to 80% stocks, 20% bonds, and Vanguard takes your money and invests it in several of their funds for you. Again, same strategy, except that your asset allocation does not change over time. Now, there are some limitations here. You have to accept the asset allocation that Vanguard has set up for these funds. If you wanted, for example, 100% stocks, well, they don't offer that option in a life strategy fund. The most aggressive they are is 80% stocks and 20% bonds. And so, there are some limitations in that way. But again, a great way to get started investing. And just to give you an idea, when you invest in a life strategy fund at Vanguard, they put your money in 4 different funds. They put your money in the Vanguard Total Stock Market Fund, the Vanguard Total International Stock Index Fund, the Vanguard Total Bond Market 2 Index Fund, and then an International Bond Fund as well. And again, how much they put in each fund depends on which of the 4 life strategy options you choose in terms of asset allocation. So I'll include a link to that in the show notes. I know sometimes it's hard to follow in a podcast, but when you go to their site, it's very easy. So again, Fidelity offers that. I'm sure Schwab does, these sort of all-in-one funds. That's another way to get instant diversification in just a single fund. So I hope this helps. I know that folks starting out, when they don't have a whole lot of money, it's sort of intimidating. And how do you do this? Sort of the logistics of all of this. And but I think if you just spend a little time with it, consider some of the suggestions I've mentioned in this podcast, you'll find that there really are some pretty easy solutions to that problem. And then, of course, once you've saved for a while, then you'll have enough to open up different mutual funds if that's what you want to do. Or, you might just end up sticking with one of these. You may do an all-in-one fund at Vanguard and decide that's fine for you. Or open an account at Betterment and then decide that's fine for you. And why complicate things? Just keep going with that strategy. I think that's fine, again, so long as it's low cost and primarily involves index passively managed funds. Again, I think there's a place for actively managed funds, but I think low-cost index funds should be the core of a portfolio. So there you go. If you have any questions at all about this, please don't hesitate to shoot me an email, dr@DoughRoller.net. And so with that, it brings us to the money tip of the day, and it goes back to the question I asked. How can you need to get some extra cash? How can you do that in a pinch? And it's something that I tried not long ago, and that was to sell my junk. I guess I shouldn't call it junk, but I don't know if you're like me, but I look around the house and I just see stuff everywhere. And I had two digital or programmable thermostats that I had bought with really good intentions of installing them, and then one didn't get installed, and then we got a new furnace that came with the thermostat. So I'm sitting here with two thermostats that I don't need. They're in the original packaging. They've been sitting in my house for over a year. And so I got on eBay. I'm just going to sell these things. I had not been on eBay to sell something in a long, long time. Man, is it easy. Particularly with an item like that, you put in you describe the item, and they've sold it so many times. They know how much it weighs. They know what it's likely going to sell for. So I put this up on eBay, and they literally, with a buy it now price, sold in about 2 minutes, each of them. And I could buy the postage through eBay. It prints out a postage label, which didn't used to be the case. Maybe it's been like that way for a long time, but it's been a while since I'd sold anything on eBay. And drop these things off at the post office. Not only did I put this to good use, for the folks buying it who needed these thermostats, I got some stuff out of my home to declutter a bit. And I think between the two, I ended up netting about $250. So that's my money tip of the day. You kind of declutter your house, you raise a little money, and you also put some stuff that's just lying around to some good use. So there you go. As always, as I said, feel free to shoot me an email, dr@DoughRoller.net. I do read and respond to every email. And you can get the show notes to this podcast. It's podcast 45. So just go to DoughRoller.net/podcast 45. So there you go. And until next time, remember, the best thing money can buy is financial freedom.